We're going to begin Intermediate 2 discussing the current liabilities and contingencies. And you need to remember that one of the things that goes on in Intermediate 2 is that we will focus on the balance sheet primarily, although we're still going to have transactions that occur for expenses and revenues and that sort of thing. The focus of Intermediate 2 is on the balance sheet and things that affect the balance sheet. So in this chapter, we'll discuss current liabilities and contingencies. Chapter 13 deals with short-term liabilities. In Part A of the chapter, the focus is on liabilities that are classified appropriately as current. In Part B of the chapter, we turn our attention to situations in where there is uncertainty as to whether the obligation really exists. These are designed as loss contingencies. Some loss contingencies are accrued as liabilities, but others are only disclosed in the notes. And in some cases, some are not disclosed at all. From a financial reporting perspective, a liability has three essential characteristics. Liabilities are probable future sacrifices of economic benefits. They arise from present obligations to transfer assets or provide services to other entities. And three, they result from past transactions or events. So think of a liability as a present obligation to make a probably future sacrifice because of a past event. In a classified balance sheet, we categorize liabilities as either current liabilities or long-term liabilities. Classifying liabilities as either current or long-term helps investors and creditors assess the relative risk of a business's liabilities. We often characterize current liabilities as obligations payable within 1 year or within the firm's operating cycle, whichever is longer. This general definition usually applies. However, a more discriminating definition identifies current liabilities as those expected to be satisfied with current assets or by the creation of other current liabilities. The common obligations reported as current liabilities are accounts payable, notes payable, commercial paper, income tax liability, and dividends payable and accrued liabilities. Classifying liabilities as either current or long-term helps investors and creditors assess the risk that the liabilities will require expenditure of cash or other assets in the near term. Is the due date years in the future, permitting resources to be used for other purposes without risking default? Or will the payment require the use of current assets and reduce the amount of liquid assets available for other uses? If so, are sufficient funds available to make necessary payments of liabilities in addition to meeting current operating needs, or must additional funds be raised by raising capital? The answers to these questions can have significant implications. Conceptually, liabilities should be recorded at their present value. In other words, the amount recorded is the present value of all anticipated cash payments resulting from the debt, specifically principal and interest payments. However, in practice, liabilities payable within 1 year are ordinarily recorded at their maturity amount. This inconsistency usually is inconsequential because of the relative short-term maturity of current liabilities makes the interest and time value component immaterial. Many businesses buy merchandise or supplies on credit. Most also find it desirable to borrow cash from time to finance their activities. These borrowing activities create liabilities, namely trade accounts, trade notes, bank liabilities, and commercial paper. Accounts payable are obligations to suppliers of merchandise or of services purchased on open account. Most trade credit is offered on open account. This means that only a formal credit instrument is the invoice. Because of the time until payment is usually short, often 30, 45, or 60 days, these liabilities are typically non-interest bearing and are recorded at their face value. The key accounting considerations relating to accounts payable are determining their existence and ensuring that they are recorded at the appropriate accounting period. Trade notes payable differ from accounts payable in that they are formally recognized by a written promissory note. Often these are somewhat longer term than open accounts and bear interest. This illustration depicts the presentation of current liabilities in a financial statement. As shown, General Mills accounts payable in 2013 amounted to $1,423 million, and its notes payable in 2013 amounted to $599.7 million. Illustration 13.1. Amounts reported on the face amount of the balance sheet seldom are sufficient to adequately describe current liabilities. Additional descriptions are shown in the illustration provided in disclosure notes. For example, here is General Mills' further explanation of the $599.7 million notes payable. The most common way for a corporation to obtain temporary financing is to arrange a short-term bank loan. When a company borrows cash from a bank and signs a promissory note, essentially an IOU, the firm's liability is reported as notes payable, sometimes bank loans or sometimes short-term borrowings. Short-term funds usually offer lower interest rates than long-term debt. About two-thirds of bank loans are short-term, but because many are routinely renewed, some tend to resemble long-term debt. In fact, some cases we will report them as long-term debt. The specific form of these short-term loans can vary, providing firms with useful financing alternatives. Usually short-term bank loans are arranged under an existing line of credit with a bank or group of banks. A line of credit is an agreement to provide short-term financing with amounts withdrawn by the borrower only when needed. Even though the loans are short-term with amounts borrowed and repaid frequently, the agreement to provide the line of credit usually lasts several years. Lines of credit can be non-committed or committed. A non-committed line of credit is an informal agreement that permits a company to borrow up to a prearranged limit without having to follow formal loan procedures and paperwork. A committed line of credit is a more formal agreement that usually requires the company to pay a commitment fee to the bank to keep the credit line available to the company. When a company borrows money, it pays the lender interest in return for using the lender's money during the term of the loan. You might think of the interest as the rent paid for using money. Interest is stated in terms of a percentage rate to be applied to the face amount of the loan. Because the stated rate typically is the annual rate when calculating interest for a short-term note, we must adjust for the fraction of the annual period that the loan spans. Interest on notes is calculated as the face amount of the loan times the annual rate times the time to maturity. As an illustration, Affiliated Technologies issued a 6-month, 12% promissory note on May 1st. To record the issuance of the note, we debit cash and credit notes payable for $700,000. Next, on November 1st, we record the interest on maturity of the note. The interest is calculated by multiplying the face amount of $700,000 by the 12% interest rate adjusted for 6 months. Therefore, the annual interest equals $42,000 for the period of 6 months. The amount of interest equals $42,000 for a period of 6 months. As the note is collected on November 1st, we reduce the liability by debiting notes payable for $700,000 and crediting cash for the total amount of $742,000. And this is found in illustration 13-3. All right, here's the concept check. Jamal borrowed $100,000 on July 1st, 2016, and signed a 4-year note bearing interest at 8%. Interest is payable fully at maturity on June 30th, 2020. Jamal should report interest expense of December 31st, 2016 of $4,000. Sometimes a bank loan assumes the form of a so-called non-interest bearing note. Obviously, though no bank will lend money without interest, non-interest bearing loans actually do bear interest, but the interest is deducted or discounted from the face amount to determine the cash proceeds made available to the borrower at the outset. For example, imagine a $700,000 non-interest bearing note with a 12% discount rate. In that case, the $42,000 would be discounted at the outset rather than explicitly stated as shown in this illustration. On November 1st, Affiliated pays $700,000 of cash, recognizes interest expense of $42,000, and reduces the notes and discount on the notes payable by amounts to zero. Notice that the amount borrowed under this arrangement is only $658,000, but the interest is calculated at the discount rate times $700,000 face amount. This causes the effective interest rate to be higher than the 12% stated rate. To calculate the effective rate, take the $42,000 interest for 6 months, divide it by $658,000, the amount borrowed, and that equals 6.38%. That's the rate for 6 months. To annualize, take the 6.38% times 12/6, or 2, equals 12.76%. See how the annual effective interest rate of 12.76 is greater than the stated rate of 12%? This is found in illustration 13-3. All right, concept check. What's the effective interest rate, rounded, on a 1-year non-interest bearing note with a stated rate of 10% and a maturity value of $100,000? We arrive at that by taking the discount rate of 10%, gives us $10,000. So we have 10,000 divided by 90,000 equals 1/9, or 11.11%. Secured loans. Sometimes short-term loans are secured, meaning a specific asset of the borrower is pledged as collateral or security for the loan. Although many kinds of assets can be pledged, the secure loans most frequently encountered in practice are secured by inventory or accounts receivable. When accounts receivable serve as the collateral, we refer to the arrangement as pledging accounts receivable. Sometimes the receivables actually are sold outright to a finance company as a means of short-term financing. This is called factoring receivables. Some large corporations obtain temporary financing by issuing commercial paper, which is often purchased by other companies as short-term investment. Commercial paper refers to unsecured notes sold at premium. sold in minimum denominations of $25,000 with maturities ranging from 30 to 270 days. Beyond 270 days, the firm would be required to file a registration statement with the SEC. Interest on commercial paper is often discounted at the issuance of the note. Usually commercial paper is issued directly to the buyer, the lender, and is backed by a line of credit with a bank. This allows the interest rate to be lower than a bank loan. Commercial paper has become an increasingly popular way for large companies to raise funds. Accrued liabilities represent expenses already incurred but not yet paid. Accrued expenses. These liabilities are recorded by adjusting entries at the end of the reporting period prior to preparing financial statements. Common examples are salaries and wages payable, income taxes payable, and interest payable. Although recorded in separate liability accounts, accrued liabilities usually are combined and reported under a single caption or perhaps two accrued liability captions in the balance sheet. Accrued interest payable arises in connection with notes and other forms of debt. As a continuation of our previous example, let's assume the fiscal period for Affiliated Technologies ends on June 30th, 2 months after the 6-month note is issued. To record the issuance of the note, we debit the cash received of $700,000 and credit notes payable for the same amount. On June 30th, the 2 months accrued interest is calculated as $700,000 times 12% times 2/12 equal to $14,000. An adjusting entry is recorded to accrue the interest, debiting interest expense and crediting interest payable for $14,000. This is found in illustration 13-6. On November 1st, the company records cash payment upon the maturity of the bond. Notes payable are reduced with a debit entry and cash is reduced with a credit entry. Interest expenses are debited for the 4 months after June 30th as calculated as $28,000, and the interest payable is recorded on June 30th, reduced with a debit entry of $14,000. Concept check. Crawley Company, whose fiscal year ends December 31st, borrowed $20,000 on December 1st, 2016, issuing a 12% 10-month note payable with interest due at maturity. When the note matures on June 30th, 2017, Crawley will write a journal entry that includes a on 12/31/16, Crawley would have recorded accrued interest of interest expense 20,000 times 12% times 4/12 equal $800, and interest payable would offset that for $800. On 6/30/2017, Crawley's journal entry would be note payable for $20,000, interest expense of 20,000 times 12 times 6 divided by 12 equals $1,200. Interest payable of 20,000 times 12% times 4/12 of the 800 from before, and cash equal to $22,000. Compensation for employee services can be in the form of hourly wages, salary, commissions, bonuses, stock compensation plans, and pensions. Accrued liabilities arrive in connection with compensation expense when employees have provided services but have not yet been paid as part of the financial statement date. These accrued expenses and related accrued liabilities are recorded by adjusting entries at the end of the reporting period prior to the financial statements. An employer should accrue an expense and the related liabilities for employees' compensation for future absences, such as vacation pay, if the obligation meets all the following four conditions. The obligation is attributable to employees' services already performed. The paid absence can be taken in a later year. The benefit vests and will be compensated even if the employment is terminated. And the benefit can be accumulated over time. 3, the payment is probable. And 4, the amount can be reasonably estimated. Here's an illustration of accounting for paid future absences. We'll start by listing the facts. Illustration 13-8. The salaries and wages expense for employees who took vacations in 2016 are calculated at the existing wage rate of $600. This expense for 2,500 employees for 2 weeks and 2,000 employees for 1 week totals to $4,200,000. The amount of compensation expense to be accrued on December 31st, 2016 is calculated as the total carryover of 9,000 weeks times the wage rate of $600, which equals $5,400,000. It is recorded as a liability towards compensated future absences. The liability for paid absences is accrued at the existing wage rate rather than at a rate estimated to be in effect when the absences occur. So if wage rates rise, the difference between the accrual and the amount paid increases compensation expense for that year. We see that occur in 2017. When the amount paid is $5,700,000 rather than the $5,400,000 accrued by the end of 2016. The difference is $300,000 and is reflected in 2017, essentially updating the estimate of compensation expense for changes occurring during 2017. Sometimes compensation packages include annual bonuses tied to the performance objectives designed to provide incentive to executives. Bonuses are compensation expense for the period in which they are earned. The most common performance measures are earnings per share, net income, and operating income. Non-financial performance measures such as customer satisfaction and product service quality are also used. Annual bonuses are popular not just for executives, but for non-managerial personnel as well. Unfortunately for employees, bonuses are often given instead of rather in addition to annual raises. This allows a company to increase employee pay without permanently locking in the increases in salaries. Liabilities are created when amounts are received that will be returned or remitted to others. Deposits and advances from customers and collections for third parties are cases in point. The main categories under this kind of liability are deposits and advances from customers, gift cards, and collections for third parties. Collecting cash from a customer as a refundable deposit or as an advance payment for products or services creates a liability to return the deposit or to supply the products or services. In some businesses, it's typical to require customers to pay cash as a deposit that will be refunded when a specific event occurs. You probably have encountered such situations. When apartments are rented, security or damage deposits are often collected. Utility companies frequently collect deposits when service is begun. Similarly, deposits sometimes are required or returnable containers, or to be refunded when the containers are returned. That situation is demonstrated in the illustration above. When 90% of the containers are returned within the allotted time, the previously collected deposit amount is refunded. The liability recorded earlier for the refund is reduced by 90% of the refundable amount, which is $270,000. This is recorded as a debit to the liability account and a credit to cash for $270,000. Note that 10% of the customers did not return the containers. Consequently, revenue is credited for the remaining amount, which equals $30,000. As the deposits were charged twice the actual cost of containers, cost of goods sold is debited for the cost of $15,000 and inventory is decreased for the containers not returned. Concept check. Glaco collected $10,000 of customer deposits for cans and bottles. As of the end of the accounting period, Glaco has redeemed 80% of the deposits and concludes that 10% of the deposits have been forfeited. Glaco should recognize revenue of Glaco will have returned 80% of the $8,000 to customers. It will recognize revenue of 10%. 10 times 10,000 equals 1,000 for forfeited deposits. The, the remaining 1,000 of deposits are still outstanding. At times, businesses require advance payments from customers that will be applied to the purchase price when the goods are delivered or services provided. Gift certificates, magazine subscriptions, layaway deposits, special order deposits, and airline tickets are all examples. This illustration highlights that the deferred revenue gets reduced when the revenue associated from the advance has been recognized, either because the seller has fulfilled the obligation to deliver the goods or services as promised, or because the buyer has forfeited the advance payment, for example, not redeeming all the gift certificate before it expires. Less often, deferred revenue is reduced when advance payment is returned by the seller to the buyer because the seller didn't deliver the goods or services as promised. Note that on December 31st, the average subscription was 1/4 expired. Thus, the seller has performed 1/4 of the obligation to deliver a year's worth of magazines and should recognize subscription revenue for that amount. Deferred subscription revenue is reduced with a debit entry by 1/4 or $5 million, and revenue is recorded with a credit to subscription revenue. Concept check. Perkins Inc. accepted an advance of $2,400 on December 1st, 2016 for providing IT help desk services for the following 6 months. On December 31st of 2016, Perkins will make an adjusting entry that includes a credit revenue of Perkins' journal entry would be deferred revenue 2,400 times 1/6 or $400 and revenue of $400. Gift cards or gift certificates are particularly common forms of advanced payments. When a company sells a gift card, it initially records the cash received as deferred revenue, then recognizes revenue either when the gift card is redeemed or when the probability of redemption is viewed as remote, which is called gift card breakage and based on expiration of the company's experience. The amounts involved can be significant. For example, Best Buy's 2014 annual report lists $406 million liability for unredeemed gift cards and $53 million of income from gift card breakage. Liabilities for deferred revenue associated with gift cards are classified as current or long-term depending on when the obligation is expected to be satisfied. Here is an illustration of liabilities towards gift cards. During May 2016, Great Buy Inc. sold 2 million of gift cards. To record this transaction, cash is debited and deferred gift card revenue is credited for $2 million. Also during May, 1.5 million of gift cards are sold in May and in prior periods were redeemed by customers. Thus, we debit the deferred revenue account while crediting revenue for 1.5 million. Also, 1 million of gift cards sold in the prior period expired unused. This further decreases the deferred revenue by 1 million and increases revenue by the same amount. Concept check. Ling Inc. sold $30,000 of gift cards during 2016. Also during 2016, 25,000 of gift cards were redeemed, some of which were sold in 2016 and some of which were sold in the prior year. Ling also concluded that 2,500 of gift cards sold in the prior year would never be redeemed, and Ling finished with 2016 with a balance of 17,500 in deferred revenue gift cards. Ling should recognize revenue in 2016 associated with gift cards of Companies often make collections for third parties from customers or employees and periodically remit these amounts to the appropriate governmental or other units. Amounts collected this way represents liabilities until remitted. Payroll-related deductions such as withholding taxes, Social Security taxes, employee insurance, employee contributions to retirement plans, and union dues also create current liabilities until the amounts collected are paid to appropriate parties. Amounts collected from employees in connection with payroll also represents liabilities until remitted. An example for third parties is sales tax. Assume a state sales tax rate of 4% and a local sales tax rate of 3%. Adding the tax to $100, the sale creates a $7 liability until the tax is paid. Given a choice, management typically would prefer to report an obligation as a non-current liability over a current liability. The reason is that most settings, outsiders like banks, bondholders, and shareholders consider debt that is payable currently to be riskier than debt that need not be paid for some time, because the current payable requires the company to be able to access the necessary cash relatively soon. Also, The long-term classification enables companies to report higher working capital, current assets minus current liabilities, and a higher current ratio. Current assets divided by current liabilities. Working capital and the current ratio are explicitly restricted in loan contracts. Long-term obligations, bonds, notes, lease liabilities, deferred tax liabilities, usually are reclassified and reported as current liabilities when they become payable within the upcoming year or operating cycle if longer than a year. Each year, the amount of payable the next year is reclassified from non-current to current. For example, a 20-year bond will be classified as non-current for 19 years, but then classified as current in its 20th year. The requirement to reclassify currently maturing debt as current liability includes debt that is callable. In other words, due on demand by the creditor in the upcoming year or operating cycle if longer, even if the debt is not expected to be called. The current liability classification also is intended to include situations in which the creditor has the right to demand payment because an existing violation of a provision of the debt agreement makes it callable. Say working capital has fallen below a minimum covenant specified in the debt agreement. This also includes situations in which debt is not yet callable but will be callable within the year if an existing violation is not corrected within a specified grace period, unless it's probable the violation will be corrected within the grace period or waived by the creditor. Short-term obligations that are expected to be refinanced on a long-term basis can be reported as non-current rather than current. Liabilities only if two conditions are met. 1. The firm must intend to refinance on a long-term basis, and 2. The firm must actually have the demonstrated ability to refinance on a long-term basis. Ability to refinance on a long-term basis can be demonstrated either by an existing refinancing agreement or by actual financing prior to the issuance of financial statements. In this example, the date of the financial statements issued, Braum Brothers has negotiated a $7 million line of credit and has also refinanced $4 million in bonds. Therefore, it has demonstrated the ability to refinance these amounts, and they can be classified as non-current. The remainder of the notes payable must be classified as current. The London Interbank Borrowing Rate is sometimes referred to as the LIBOR. Concept checked. Kim's Academy has $10 million of X bonds payable due in 2017. Prior to 12/31/16, Kim refinanced $3 million of the X bonds with other bonds that mature in 2027. On January 15, 2017, Kim refinanced another $2 million of the X bonds with others that mature in 2024. Kim issued its financial statements on February 1, 2017. On February 15th, Kim refinanced another $4 million of the X bonds with others that mature in 2025. In its 2016 financial statements, Kim should show non-current bonds payable of the $3 million refinanced prior to the end of the year, plus $2 million refinanced prior to the issuance of the financial statements. $5 million classified as non-current. Contingencies. Let's now discuss another important category of liabilities, and that is loss contingencies. A loss contingency reflects an existing uncertain situation involving a potential loss, depending on whether some future event occurs. How we account for these situations depends on the likelihood that the future event that confirms the amount to be paid will occur. GAAP somewhat arbitrarily identifies the probability levels as probable, confirming the event is likely to occur; possible, or reasonably possible, the chance of the confirming event will occur is more than remote but less than likely; and remote, the chance of confirming event will occur is slight. Also, the amount of the potential classification is either known, reasonably estimable, or not reasonably estimable. This exhibit highlights the appropriate accounting treatment for each possible combination of A, the likelihood of obligations being confirmed, and B, the determinability of the dollar amount. When a loss contingency is accrued, we debit a loss or expense and typically credit the liability account. However, note that some contingent losses do not involve liabilities at all. Rather, these contingencies, when resolved, cause a non-cash asset to be incurred. So, so accruing the contingency means reducing the related asset rather than recording a liability. A common example of that sort of contingency is bad debts expense. The uncertain future outcome is payment by the customer, so rather than establishing a liability, we create a contra account, the allowance for bad debts. This reduces the carrying value of the receivable to the amount the seller expects to realize. All right, now I want you to note here that you will, for the exam, you will want to basically memorize this illustration 13-16, where you have the dollar amount of potential loss is either known, reasonably estimable, or reasonably not estimable, and the likelihood is probable, reasonably probable, or remote. Notice, if it is remote, no disclosure is required ever. So remote is not required. If it is reasonably possible, it is disclosure only. It is only when it is probable and known or probable and reasonably estimable do we have to actually accrue the liability and make a disclosure note. Concept check. GK Inc. has the following outstanding litigation claim against it. A claim of $100,000 GK thinks is probable and will lose the claim and estimates the loss at $75,000 if it occurs. A claim of $50,000 GK thinks it is probable it will lose the claim but cannot estimate the amount of loss. A claim of $10,000 GK thinks it is reasonably possible to lose the claim and estimates the loss at $8,000 if it occurs. GK should accrue a contingent liability of only the amount is both probable and reasonably estimable, and that is $75,000. A quality assurance warranty is a common form of contingent liability. It is a guarantee by the seller that the customer will be satisfied with the goods or services that the seller provided. Why do sellers offer quality assurance warranties? To boost sales. It follows then that any cost of making goods on such guarantee should be estimated and recorded as expenses in the same accounting period as the products are sold, matching expenses with revenues. Also, it is in the period of sale that the company becomes obligated to eventually make good on the guarantee. So it makes sense that to recognize a liability in the period of sale. The challenge is that much of the cost of satisfying a guarantee usually occurs later, sometimes years later. This is a loss contingency. There may be a future sacrifice of economic benefits, cost of satisfying the guarantee, due to an existing circumstance. The guaranteed products have been sold that depends on an uncertain future event, a customer claim. This illustration demonstrates the accrual of the contingent liability for warranties in the reporting period in which the product under warranty is sold. Estimates of warranty costs cannot be expected to be precise. However, if the estimating method is monitored and revised when necessary, overestimates and underestimates should cancel each other out over time, and estimates can be adjusted as necessary to reflect changes in circumstances. The estimated liability may be classified as current or as part of current and part long term, depending on when the warranty claims are expected to be satisfied. On December 31st, Caldor Health has to record an adjusting entry to recognize any warranty expense and a warranty liability. Calder estimates warranty costs to be 3% of sales during the first 12 months following the sale and 4% in the next 12 months. Therefore, the warranty liability can be calculated as 7%, the sum of 3% for the first 12 months plus 4% for the next 12 months, times the amount of sale of $2 million. Thus, the warranty liability is estimated to be $140,000. Consequently, the adjusting entry is a debit to warranty expense and a credit to estimated warranty liability for $140,000. Now let's assume that Caldor incurred a cost of $61,000 to satisfy customer claims in 2017. This requires Caldor to reduce its liability, debiting estimated warranty liability for the $61,000. Cash, wages payable, or parts and supplies, on the other hand, are credited for the same amount, depending on which is necessary to satisfy the claims. Concept check. Omega provided quality assurance warranties on clock sales, promising full refund if not satisfied after 90 days. Omega estimates that 2% of sales will be refunded and made $200,000 of sales in 2016. Omega incurred $3,000 of costs fulfilling warranties in 2016. Omega would recognize 2016 warranty expense of the traditional way of measuring a warranty obligation is to report the best estimate of future cash flows, ignoring the time value of money on the basis of immateriality. However, when a warranty obligation spans more than 1 year, we can associate probabilities with possible cash flow outcomes, an approach described by Statement of Financial Accounting Edition number 7. Offers a more plausible estimate of the warranty obligation. This expected cash flow approach incorporates specific probabilities of cash flows into the analysis. If it offers to take away any account uncertainty concerning the amounts and timing of the cash flows. Now let's assume that Caldor Health estimates specific probabilities of warranty costs for 2017 and 2018. It estimates a 20% probability of incurring a $50,000 of warranty costs during 2017. Consequently, the expected cash flow would be $10,000, equal to 20% times 50,000. The other expected cash flows are calculated in a similar fashion, and the total expected cash flow during 2017 of warranty costs is thus 61,000, and for 2018 is 81,000. We know that we also must determine the time value of these expected cash flow amounts. We use a risk-free interest rate of 5% as the uncertainty associated with the cash flows has already been included in our estimates by using the expected values. The present value of the expected cash flow amount for 2017 is $61,000. What that number is discounted by, the present value factor for 1 year at 5%, which is 0.95238. The present value is $58,095. The present value of the warranty cost for 2018 is $73,469. The present value of the total warranty cost is $131,564. Concept check. Kappa sold product in 2016 for which it believes there is a 40% chance it will incur a $100,000 of warranty cost in 2 years and a 60% chance it will incur $200,000 of warranty costs in 2 years. Under the expected cash flow approach, which of the following is not true? Under the expected cash flow approach, Kappa would discount the expected cash flow at the risk-free rate. The expected cash flow is 40% times 100,000 plus 60% times 200,000, or 160,000. Caldor Health will make an adjusting entry to record the warranty liability on December 31st, 2016, debiting warranty expense and crediting estimated warranty liability for $134,564. An extended warranty provides warranty protection beyond the manufacturer's original warranty. Because an extended warranty is priced and sold separately from the warranted product, it constitutes a separate performance obligation. Cash typically is received up front when the extended warranty is sold. However, revenue from separately priced extended warranty contracts is not recognized immediately, but instead is recorded as a deferred revenue liability at the time of sale and recognized as revenue over the contract period. Revenue is recognized when performance obligations are satisfied, not necessarily when cash is received. Because an extended warranty provides coverage over a period of time, these arrangements typically qualify for revenue recognition over a period of coverage, typically on a straight line basis. This illustration demonstrates the accounting for extended warranties. When the extended warranty is sold, brand name recognizes cash and records a liability, deferred revenue. Extended warranties for $60. Every year for the next 3 years, deferred revenue is debited and revenue is credited by $20 for the extended warranty, recognizing that brand name has fulfilled a year's worth of performance obligation by providing warranty coverage during that year. Brand name would also recognize expenses associated with satisfying warranty claims in the year in which those costs are incurred. Concept check. Major, Inc. sold a $120 extended warranty at the same time it sold a $480 snowblower on October 1st, 2016. The warranty covers 3 years of repairs. During 2016, Major would recognize warranty revenue of A common contingent loss occurs when a company is being sued. While the company may accrue estimated lawyer fees and other legal costs, they usually do not record a loss until after the ultimate settlement has been reached or negotiations for settlement are substantially completed. The SEC pressures firms for more complete disclosure of litigation, including better descriptions of the range of losses that are reasonably possible to incur. This illustration, the disclosure is about the estimate of the aggregate range of reasonably possible losses from legal proceedings. Even after the firm loses in court, it may not make an accrual. As you can see this illustration, the Las Vegas Sands Corporation, in a recent annual report, disclosed but did not accrue damages from a lawsuit it lost because the company was appealing the verdict. It's important to remember that several weeks usually pass between the end of a company's fiscal year and the date the financial statements for that year are actually issued or available to be issued. As shown on the same timeline, events occurring during this period can be used to clarify the nature of financial statement elements at the report date. If information becomes available that sheds light on a claim that existed when the fiscal year ended, that information should be used in determining the probability of a loss contingency materializing and in estimating the amount of the loss. In the illustration, Kraft was suing Starbucks and the case had been in litigation for several years. On November 12, 2013, after Starbucks' September 29th fiscal year end, an arbitrator ordered payment of damages, which clarified the amount that Starbucks would have to pay for litigation that existed prior to the end of the year. Therefore, that amount is included in the litigation charges in the fiscal year 2013 results. Sometimes the event causing a loss contingency occurs after the end of the year, but before the financial statements are issued, as shown on the timeline. When a contingency becomes into existence after the company's fiscal year end, a liability is not accrued because it didn't exist at the end of the year. However, if the failure to disclose the possible loss would cause the financial statements to be misleading, the situation should be described in a disclosure note, including the effect on the possible loss on key accounting numbers. For example, a disclosure note of Hess Corporation from its 2013 annual report describes events that occurred in the first quarter of 2014. Portland's Best Coffee had a litigation claim of $100,000 against it. As of 12/31/2016, Portland considered it probable that it could lose $75,000 on the claim. After the 2016 year end, but before issuance of the financial statements, Portland settled the litigation for $60,000. How much of a litigation liability should Portland show on its 12/31/16 financial statements? Portland should use the information from the subsequent event of settlement of the litigation to help it estimate the amount of liability that should be included in its 12/31/16 financial statements. Even if a claim has yet to be made when the financial statements are issued, a contingency may warrant accrual or disclosure. In this case, a two-step process is involved in deciding how the unasserted claim should be reported. 1. Is it probable that the claim will be asserted? If the answer to that question is no, stop. No accrual or disclosure is necessary. If the answer is yes, go on to step 2. 2. Treat the claim as if the claim has been asserted. This requires evaluating A, the likelihood of an unfavorable outcome, and B, whether the dollar amount of the loss can be estimated, just as we already have discussed for other loss contingencies for which a claim has already been asserted. As described on a December 31st, 2013 disclosure note, see the above illustration, Union Pacific concluded that some unasserted claims met the criteria for accrual under its two-step decision process. Concept check. Boone Farms believed it is possible, but not probable, that it will be sued for breach of contract. Boone anticipates that the lawsuit will be for $100,000, that there is a 90% chance it will lose if the suit is brought, and that the amount it will lose is $80,000. Boone should recognize a liability of Because it is not probable the claim will be asserted, Boone does not record the liability. A gain contingency is an uncertain situation that might result in a gain. For example, in a pending lawsuit, one side, the defendant, faces a loss contingency. On the other hand, the plaintiff has a gain contingency. Loss contingencies are accrued when it's probable that an amount will be paid and an amount can be reasonably estimated. However, gain contingencies is an example of conservatism, following the reasoning that it's desirable to anticipate losses, but recognizing that gains should wait until their realization. Though gain contingencies are not recorded in the accounts material, ones are disclosed in the notes in the financial statement. Companies should take care that the disclosure note not give misleading implication as to the likelihood of realization. International Accounting Standard Number 37, Provisions, Contingent Liabilities, and Contingent Assets, prescribes the accounting contingencies. IFRS and U.S. GAAP are quite similar in respect to the accounting for contingent losses. However, there are some important differences. First, regarding classification, IFRS classifies the liabilities payable within the coming year as long-term only if refinancing is completed before the balance sheet date. Under U.S. GAAP, liabilities payable within the coming year are classified as long-term if refinancing is completed before the date of issuance of the financial statements. Second, regarding contingencies, there are several differences. While IFRS refers to accrued liabilities as provisions and refers to possible obligations that are not accrued as contingent liabilities, U.S. GAAP refers to all these obligations as contingent liabilities. IFRS defines probable as more likely than not, in other words, any likelihood greater than 50%. The threshold is lower than what is typically associated with probable in U.S. GAAP. IFRS requires disclosure but not accrual of two types of contingent liabilities. One, possible obligations whose existence will be confirmed by some uncertain future events that the company does not control, and two, a present obligation for which either it is not probable that a future outflow will occur or the amount of future outflow cannot be measured with sufficient reliability. No such distinction is made under U.S. GAAP, but U.S. GAAP does require disclosure of such contingencies. IFRS measures the liability as the best estimate of the expenditure required to settle the present obligation out of the range of possible outcomes. IFRS uses the midpoint of the range, while US GAAP requires use of the low end of the range. Now, I want you to note under US standards, we talked about US GAAP standards, we talked about probable. Is something probable? There is no percentage definition of what is probable. It is a judgment call. It relies on the professional judgment of the accountant and the auditor to come up with what is probable. IFRS considers the time value of money to estimate the liability. If that time value has a material impact, the liability is stated at present value by IFRS. US GAAP does not allow the usage of present value in all the circumstances. For example, US GAAP does not allow the usage of time value of money for discounting loss contingencies like litigation. IFRS recognize provisions and contingencies for onerous contracts, defined as those which are unavoidable costs of meeting obligations exceed the expected benefits. Generally, US GAAP does not disclose or recognize losses on such money-losing contracts. Some exceptions, losses on long-term construction contracts, are accrued, as are losses on contracts that have been terminated. Current liabilities impact a company's liquidity. Liquidity refers to a company's cash position and overall ability to obtain cash in the normal course of business. A company is said to be liquid if it has sufficient cash or other assets convertible to cash in a relatively short time to pay. Currently maturing debts, managers as well as outside investors and creditors should maintain close scrutiny on the liquidity of a company. To measure the company's liquidity, we compare liabilities that must be satisfied in the near term with assets that either are cash or will be converted to cash in the near term. The current ratio is determined by dividing current assets by current liabilities. It is a measure of short-term solvency. A ratio of 1 to 1 or higher often is considered a rule of thumb standard, but like other ratios, acceptability should be evaluated in the context of the industry in which the company operates and other specific circumstances. Industry averages are only one indication of adequacy, and that the current ratio is but one indication of liquidity. We can adjust for the implicit assumption of the current ratio that all current assets are equally liquid. The acid test ratio, or quick ratio, is similar to the current ratio, but is based on a more conservative measure of assets' ability to pay current liabilities. Specifically, the numerator, quick assets, includes only cash and cash equivalents, the short-term investments, and accounts receivable. By eliminating current assets such as inventories and prepaid expenses that are less readily convertible into cash, the acid test ratio provides a more stringent indication of a company's ability, short-term solvency, than does the current ratio. As with other liquidity ratios, watch out if the company appears significantly less liquid than its industry peers. Managing working capital is an important part of maintaining liquidity as well as profitability. For example, well-managed companies typically view their accounts payable as a free loan from their suppliers, just as they view their accounts receivable as a free loan to their customers. These companies tend to pressure their customers to pay quickly, but try to obtain more extended terms with their suppliers. Although this would produce relatively low current assets and high current liabilities, and therefore a lower current ratio, it could be a very intelligent way to manage cash and decrease the overall amount of capital needed by the company to finance operations. A company might use its economic muscle or persuasive powers to influence the timing of accounts payable recognition by asking suppliers to change their delivery schedules. Because accounts payable is included in the denominator in most measures of liquidity, such as the current ratio, the timing of their recognition could mean the difference between an unacceptable ratio and an acceptable one, or between violating a debt covenant and compliance. Some firms that report deferred revenue may manipulate the timing of revenue recognition to manage their earnings. All financial statement users need to keep in mind the relation between the recognition of deferred revenue associated with advance payments and later recognition of revenue. Increases in deferred revenue can signal future revenue recognition because the deferred revenue likely will be recognized as revenue. Management use deferred revenue as a tool to manage their earnings. All firms incur liabilities in connection with their payroll. These liabilities arise primarily from legal requirements to withhold taxes from employees' paychecks and from payroll taxes on the firms themselves. Some payroll-related liabilities result from the voluntary payroll deductions of amounts payable to third parties. Employers are required by law to withhold federal income taxes, sometimes state income taxes, and Social Security taxes from their employees' paychecks and remit these to the Internal Revenue Service. The amount withheld for federal income taxes is determined by a tax table furnished by the IRS and varies according to the amount earned and the number of exemptions claimed by employees. The employer must also pay an equal, matching amount on behalf of the employee. Self-employed persons must pay both the employer and the employee portions. Besides the required deductions for income taxes and Social Security taxes, employees often authorize their employers to deduct other amounts from their paycheck. These deductions might include union dues, contributions to savings or retirement plans, and insurance premiums. Amounts deducted this way represent liabilities until paid to the appropriate organization. One payroll tax mentioned previously is the employer's matching amount of FICA taxes. The employer must also pay federal and state unemployment taxes on behalf of its employees. In addition to salaries and wages, withholding taxes, and payroll taxes, many companies provide employees with a variety of fringe benefits. Most commonly, employers pay all of an employees' insurance premiums and/or contributions to retirement income plans. Here's an illustration of a payroll-related liabilities. As you study the illustration, you should note the similarity among all payroll-related liabilities. Amounts withheld from the paycheck, voluntarily or involuntarily, are liabilities until turned over to the appropriate third parties. Payroll taxes and expenses for fringe benefits are incurred as a result of services performed by employees and also are liabilities until paid to appropriate third parties. To record the payroll, Crescent will make the following journal entries. Salaries and wages expense will be debited and withholding taxes and federal and state income taxes will be credited. Social Security taxes payable, Medicare taxes payable, amount payable to Blue Cross, to Fidelity Investments, to Local 222, and the remaining amount of salaries or wages payable will all be credited. To record the payroll expense, the payroll tax will be debited, Social Security taxes, Medicare taxes, FUTA payable, and state unemployment tax payable will be credited. Salaries and wages expense will be debited, and fringe benefits and the payable to Blue Cross, Fidelity Investments, and Prudential Life will be credited. This concludes Chapter 13.